Hey everyone, welcome back to the channel. Today, we're diving into a topic that so many of you have asked about. The stock market. It might feel a bit tricky or even scary at first, but trust me, it might feel a bit tricky or even scary at first. But trust me, by the end of this video, you'll totally get the basics and feel super confident. At the end of this video, you'll totally get the basics and feel super confident. Let's dive in and make this fun together. We're going to break down what the stock market is, why people invest in it, and most importantly, how you can decide if you're ready to start your own investment journey. So grab a notebook, get comfortable, and let's get started on demystifying the world of stocks. First things first, what exactly is the stock market? Imagine a huge marketplace, but instead of selling fruits and vegetables, people are buying and selling tiny pieces of companies. These tiny pieces are called stocks or shares. When you buy a stock, you're not just getting a piece of paper, you're becoming a part owner of that company. If the company does well, makes a lot of profit, and grows, the value of your share can go up. If it doesn't do so well, the value can go down. The stock market is simply the collection of all these exchanges where this buying and selling happens. Like the New York Stock Exchange or the Nasdaq, it's the engine room of the economy, helping companies raise money to grow, innovate, and create jobs. So, why would anyone want to jump into this? What's the point of investing in stocks? Well, the main reason is to grow your money over time. Let's be real. Just leaving your cash in a standard savings account isn't going to make you rich. With inflation, the value of that cash actually decreases over time. The stock market, on the other hand, has historically provided returns that outpace inflation. It's a powerful tool for building long-term wealth. Think about your future goals. Maybe you want to buy a house, retire comfortably, or pay for your kids' education. Investing can be a key strategy to help you reach those goals faster. It's about making your money work for you, even while you sleep. Now, before you get too excited and start downloading trading apps, we need to have a serious chat. Investing isn't a get-rich-quick scheme. It comes with risks. The value of stocks can be volatile, meaning they can go up and down pretty dramatically. This is why it's crucial to assess your own financial situation before you even think about investing. The first and most important step is to build an emergency fund. This is a stash of cash, usually 3 to 6 months' worth of your essential living expenses, kept in a separate, easily accessible savings account. This fund is your financial safety net. If you lose your job or have an unexpected medical bill, you can use this money instead of being forced to sell your investments at a bad time. Investing without an emergency fund is like walking a tightrope without a net. It's just too risky. The next thing to tackle is high-interest debt. I'm talking about things like credit card debt, which can have interest rates of 20% or even higher. Think about it this way. The stock market has historically returned an average of around 7 to 10% per year over the long term. If you're paying 20% interest on a credit card, any gains you make in the market are being completely wiped out by your debt. It's like trying to fill a bucket with a hole in it. Prioritize paying off that high-interest debt before you start investing. It's one of the best guaranteed returns on your money you can get. Now, this doesn't necessarily include all debt. Things like a low-interest mortgage or a student loan might be different. But that high-interest consumer debt is a major roadblock to building wealth. Once you have your emergency fund and your high-interest debt is under control, you need a clear budget. You need to know exactly how much money is coming in and where it's all going. This will help you figure out how much you can comfortably afford to invest each month without straining your finances. It doesn't have to be a huge amount. Even starting with $50 or $100 a month is fantastic. The key is consistency. Creating a budget isn't about restricting yourself. It's about empowering yourself by taking control of your money. It gives you the clarity to make smart financial decisions, including how much you can allocate towards your investment goals. Okay, so let's say you've checked all those boxes. You're debt-free. You've got an emergency fund, and you have a budget. Now what? Let's talk about the different ways you can actually invest. The simplest and most recommended path for beginners is through index funds, or ETF, which are exchange-traded funds. An index fund is like a basket that holds stocks of many different companies. For example, an S&P 500 index fund holds stocks from the 500 largest companies in the U.S. By buying just one share of this fund, you are instantly diversified across all those companies. This is so important because it spreads out your risk. If one company in the fund does poorly, it's balanced out by the other 499. Don't put all your eggs in one basket, right? ETFs work in a very similar way and are traded like individual stocks on an exchange. They are a fantastic low-cost way to get broad market exposure without having to pick individual winner stocks, which is incredibly difficult, even for professionals. Another option you might hear about is individual stocks. This is where you research and buy shares in specific companies you believe in, like Apple or Tesla or Amazon. While the potential for high returns can be tempting, this approach carries much more risk. If you put all your money into one company and it fails, you could lose everything. It also requires a lot of research and time to stay on top of the company's performance, its industry, and the overall market. For most beginners, sticking with diversified index funds or ETFs is a much safer and less stressful strategy. You can always explore individual stocks later as you gain more knowledge and experience. Let's talk about a superpower in investing: compound interest. Albert Einstein supposedly called it the eighth wonder of the world. And for good reason. Compounding is basically your money making money, and then that new money also starts making money. It's a snowball effect. The earlier you start investing, the more time your money has to grow and compound. Let me give you a quick example. Imagine putting away $100 a month from age 25. By the time you're 65, assuming a 7% average annual return, you could have over $200,000. But if you wait until you're 35 to start, you'd end up with just under $100,000. That 10-year delay costs you more than half of your potential gains. This illustrates why time in the market is so much more important than trying to time the market. The best time to start was yesterday. The second best time is today. Finally, I want to talk about mindset. This is perhaps the most underrated, yet most critical, part of being a successful investor. The stock market is emotional. When you see your account balance go down during a market downturn, it's natural to feel scared and want to sell everything. This is called panic selling, and it's one of the biggest mistakes investors make. They sell when prices are low and then often miss out on the recovery. The key is to have a long-term perspective. Understand that market corrections and downturns are a normal part of investing. They happen. If you've invested in solid, diversified funds, history is one of the biggest mistakes investors make. They sell when prices are low and then often miss out on the recovery. The key is to have a long-term perspective. Understand that market corrections and downturns are a normal part of investing. They happen. If you've invested in solid, diversified funds, history shows that the market has always recovered and gone on to reach new highs. So stay calm, stay the course, and remember why you started investing in the first place. Don't check your portfolio every day. It will only drive you crazy. Think in terms of years and decades, not days and weeks. So, to recap, before you invest, build an emergency fund, pay off high-interest debt, and create a budget. When you're ready to start, consider low-cost, diversified index funds, or ETFs, as a great starting point. Understand the power of compounding and start as early as you can, even with small amounts. And most importantly, cultivate a long-term mindset and don't panic when the market gets bumpy. Investing is a marathon, not a sprint. It's about patiently building wealth over time to secure your financial future. I hope this has cleared up some of the mysteries surrounding the stock market for you. The goal isn't to become a Wall Street guru overnight. It's about taking that first informed step. If you found this video helpful, please give it a thumbs up and hit that subscribe button so you don't miss our future content. What's the one thing that's stopping you from diving into investing? Let me know in what's the one thing that's stopping you from diving into investing. Let me know in the comments. Let's chat about it. Thanks for watching, and I'll see you in the next one. Invest. Let's chat about it. Thanks for watching, and I'll see you in the next one.